This podcast is for informational purposes only and is not an offer or solicitation of any offer to buy or sell securities. SNN.Network and Maj Soueidan are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast. Welcome back to Avoiding the Crowd podcast with your host, Maj Soueidan. I'm the show's producer, Robert Kraft. And joining us on this very special episode that is really awesome is our anonymous investor in the markets, our favorite anonymous Australian investor, the Gladiator HC, at the Gladiator HC on Twitter. So I'd like to welcome you all to this episode. Maj, Gladiator, say what up.
Wow, I'm your favorite. That's a huge compliment. But you said favorite Aussie as well, so not the favorite about Aussie, but that's good.
Well, no, look, I have to be diplomatic. There's many anonymous investors now. You just happen to be the only Aussie anonymous investor, so that's why you're also our favorite.
I'll take it.
And Mosh, what's going on, host? How you doing?
I'm great, man. I had a good weekend. I'm glad I'm here with Gladio. We've talked a lot on Twitter here and there, and it's good to finally talk to him live. It should be fun.
Yeah, this should be fun. That's for sure. And if everybody watching this, I know y'all are missing Maj's backdrop, but don't worry, it'll be back soon, right? Your geo investing backdrop, right?
Oh yeah. I got yelled at for not having a good one, so I had to. My brother didn't like it so much.
Well, you know what you got to do? You got to make like one in like where it's like the logo in the corner. I see that. I see that a lot. That's like a nice way of doing it.
That's why I stocks and nothing else, because I don't have anything else.
Yeah. That's good stuff. Well, let me set the stage here. Everybody who's watching this today, the reason that we invited the Gladiator HC on today to join us for Avoiding the Crowd is because he just wrote a really awesome article. It was kind of a Q&A with Maj recently that he published on his website. So we invited him on to join us for the whole episode, not only to talk about that article itself, but then we're going to go into Maj's most recent newsletter and talk about some of the things on there. So, I figured with that, I'm going to shut up. I'm going to get out of here. And Maj, Gladiator, floor is yours, guys.
Yeah, thanks, man. Hey, and Gladiator, I want to really talk about what he's doing too on his website. He's doing a lot of good things, writes a lot of good, I think, educational articles from his own perspective of investing over the years, success and failures. And I think he's running a class right now, how to maybe pick stocks and some kind of challenge, called the $50,000 challenge. So we should talk about that too. But yeah, Gladiator, I really never, you kind of, asked me a lot of questions and, I went through them to learn about me, but I'd like to know more about you. I don't think we ever had that like intense conversation. Maybe you could get into that a little bit and some of your history.
Yeah, sure. Yeah, so I kind of stumbled upon the stock market and penny stocks back in 2009. So I am still, but I was predominantly a real estate investor back then, and just in the process of saving up some money to get another property, I thought I'll try and learn a new skill instead of just sitting around and just saving for a couple of years. So the next logical kind of investment vehicle is the stock market. So I went onto this website called Hot Copper, and luckily for me, they predominantly focus on penny stocks. And so without really even knowing it, I had just thrown myself into the world of penny stocks and MicroCap stocks. And I was doing that pretty much since 2010, as in actively getting involved in buying stocks. And it took me about, made a lot of stocks, and I talk about these in my articles, made a lot of failures, a lot of mistakes, which I think pretty much every investor would do early in their career. And it took me about 5 years to even get back my money. So, I was doing, I semi-calculated about 5,000 hours in that time to be able to actually get my money back. So I think that's where most people kind of fall over, is they get to the point where they've lost a lot of money, they finally get it back, and then they sigh of relief and they quit. And I think that's probably the worst time to quit, because after all that knowledge and after all that experience to get back to the point where you've finally broken even is a huge milestone. It's not something to be upset about that you've lost some money. Everybody does it. So that took me to about 2015 where I finally got my money back. And then from then, just really focusing on less about, making money, more about kind of enforcing my strategy. And I think that's where things started to turn around when, stop trying to get in these, get rich quick schemes, stop investing in oil drillers and explorers who are, it's either a plus 500% or a minus 95% overnight. And just trying to find some really great companies that you can invest in the medium to long term. And, I think you call them tier one microcaps, where they're, real companies doing real things, management who are dedicated, they've got skin in the game. And when I started to focus more on that, my success and my luck really started to turn, which has been great. And honestly, I'm loving it more than I ever have. And I didn't think back in 2009/10 that I would actually enjoy it this much. Now real estate investing is kind of not to the side, but I much more focus on my microcap investing because it's kind of my passion at the moment.
Excellent. Yeah. And I kind of went through a similar path in part of my career. I didn't get into penny stocks till later on. Maybe I would say, mid-career, I guess, wise as a full-time investor. And I went through that same kind of, you get kind of caught up in the whole penny stock thing. And there's a lot of, story stocks in penny stock land. And it's really hard sometimes when you first get introduced to it, hard to dissect what's a good story and what's a great company. And, that took some time, and it took me a few years to get that right too. But it's cool because there's a lot of investors out there who just believe penny stocks are all trash. And, when it comes down to it, they're not all. I mean, there might be a lot going through a lot of, turnarounds of stuff or problems they're facing and challenges. Maybe that's why they are penny stocks, but it doesn't mean they're shitty companies all the time. And, with a good management team and a clean capital structure and a potential catalyst, you never know when those things, those pennies can turn into, $1, $3, $4, $5 stocks over time. And I think we kind of hit that same kind of, realization over time. But,
I think that's our advantage, right? Where everyone thinks they're rubbish stocks. And if we had, the vast majority of stock market investors moving from large caps to micro cap stocks, then, it wouldn't be such an inefficient market, which is, it's what we try and take advantage of, right? These stocks where people are underestimating them, that's writing them off because of either their market cap or the share price being so low, or, so hopefully people keep hating them.
Yeah. Well, what's nice about the universe is that, that they're always going to be inefficient. That's to some degree. They'll gain in popularity, but you're never going to be to where a total efficiency, especially in our tier one space, because a lot of microcap investors are, especially maybe newbies or whatever, they're chasing these like we used to chase all the time, right?
Yeah.
Chasing those story stocks, and because they offer the allure of quick gains overnight, and they ignore some of these stocks, and may take a little time to marinate to get better. But what is interesting too, that once in the right environment, tier one companies can also do very well too in the short term. And I think we're kind of in a sweet spot on that right now, actually. And
I completely agree. Yeah.
We say tier one, I think I cover it, and let me see if I can find it here, Gladiator, in the I think we cover it in the article that we talked about, or we contributed.
Yeah, we did. It was in your strategy section.
I'm trying to find it. Yeah. So basically, I'll just go over them real quick. There are a lot of them are obvious, and a strong management team, management focus on the business and not the stock price movement necessarily. Solid, respectable level of revenue, even if it's just starting, but at least having some revenue. At or near profitability. I love high probability turnaround companies because they're often ignored. If you get them maybe in the 5th or 6th inning, you can get some really good pricing.
Yeah, Bobby and I actually went through that in our first podcast, and I think we're very similar in that regard, where if you can pick the company right at its turnaround stage, there's a really high chance that you can realize some massive gains. Obviously, you still got to follow your strategy and make sure management have skin in the game. Like you said, make sure they're actually kicking some goals, whether it be revenue or whatever it is they're aiming for. But that moment of them changing from the stock it's been smashed for so long because previous management haven't delivered and they've just been replaced, or they've just picked up a new acquisition, or their product is really starting to get some momentum. That turnaround stage is where I love to get set myself to.
You know, it's become one of my favorite things to do. I mean, I didn't invest in any turnarounds in the very beginning of it. I was trying to look at all these like obvious, simple stories that, you know, just were clean companies, were undervalued, and at that, 20, 30 years ago, that was a little easier because the market was a little less efficient. Now that it's more efficient, sometimes you got to dig a little deeper and trying to get these stocks earlier. And I enjoy it a lot, actually, like as you do, and
Yeah.
especially that management thing. There's a situation where if you find the right management team, it's really almost a high probability bets in some of these plays, and that's probably the most important thing to have though in these turnarounds is a good management team that as you've done it before, or even has made some mistakes and met the challenges and was able to go power through mistakes. I love those too. Like finding a company where a CEO admits he made a mistake, and then or she makes a mistake and find some way to correct it and come back even stronger. Now you've gone through a situation where a CEO has been through a challenge and conquered it, and that's one challenge maybe he'll never have to face again because he's been able to get through it once, and it kind of makes our investment safer sometimes to invest in a good CEO that's had some issues and got through it. I don't know if that's something you've kind of looked at yourself too. But.
Yeah, absolutely. And I loved that you called out in your Q&A the example of, the CEO who said to you, why is dilution bad? I think a huge reason for some of these micro-cap stocks not getting any traction is they're just not run by people who actually understand how this ecosystem works. And, they'll just dilute the hell out of a stock just thinking, we need the money, so I need to raise it now. But there's ways of doing it. You can stagger the raises, show some momentum, raise again at a higher price, reduce dilution, that kind of stuff. But yeah, it was funny when, if a CEO is saying to you, why is dilution bad? Then I'd probably avoid that company, regardless of how much revenue they've got.
Yeah, it was funny because that was one of my site visits I did several years ago. And I was actually I spent 2 days with the company, touring the facilities. They had a few different facilities, interviewing employees, interviewing different, people with the management team. And, I felt pretty good about the company and what they were doing. And then, on the drive home, the CEO decided to give me a ride to the airport. It was like a good hour and a half ride. And it was during the end of my trip that I started figuring these, kind of weaknesses. And we started talking about dilution. He's like, well, what's dilution? Why does it matter? Why? I mean, I still own, if I own 300 shares of stock, I own 300 shares of stock. Well, no, you have the company. So I said, I got home, I can't buy. I don't care how good, I don't even care if the stock went up at that point. I think at some point I'm going to get screwed by a company that doesn't understand, what that means. And it was a situation where I think the CEO kind of got handed the company through different, generation, and just was handed a really good company, and it's doing fine today. But it wasn't the CEO I wanted to invest in, so I kind of passed. Actually, the stock did go up after, significantly after I sold it. But I still don't blame myself for doing that.
Yeah, no, great. It's all about putting the odds into your favor, right? And if you've got, and I'm sure he's got the best intentions at heart, but if you don't understand how not just how a business is run, but how the stock market runs and how the microcap space runs, you can do a lot of damage to a stock, even if you're kicking goals in the company itself.
Oh, sure. Actually, Bobby, there was a company I interviewed at your conference that a little upset that, he didn't quite get that whole, didn't mind about diluting. It was all about growing, issuing shares, making acquisitions, and growing revenue at any cost. And he just didn't, we were going back and forth on that, and he just didn't get the whole, you can't blow your share count up. At some point, it's going to matter. And so there's still a lot of management teams that don't understand that whole concept today. And they want to grow and capture market share. They don't understand. Sometimes I got to say no. Sometimes you say no and really dominate what you're already doing well, if you are doing it well. And let somebody else have some of that market, man. Go ahead. If you can just do a lot really good in your market. And maybe eventually you'll be strong enough to steal that market eventually.
Yeah, and I know we're talking about equity raises and it's normally viewed in a negative light, but I think in the microcap space for the majority of stocks, they need equity to run. It's just about doing it in the right way. So I'll give an example. If I've got because on the ASX, we've got a lot of mining stocks. If you've got a mining explorer that needs, say, $3 million to drill a site and try to define a JORC number, then instead of raising $3 million right from the outset, raise 500,000. Do a bit of exploring. Try to see if you can find the areas that have the highest potential for the drill bit to hit something, that will actually result in the share price appreciating. Then raise another 500,000. And as you're going, and raise as you go, because let's say that lease in particular, this is using a story stock as an example. That lease is a dud. You just raised $3 million and 500,000 in. You've realized that there's nothing in the ground. Then that cash is just going to be sitting there. And you just diluted everybody for no reason. So I think raising money is okay when they're doing it in the right way and they're doing it to realize goals that'll eventually lead to the share price, increasing over time. But I think it's a problem in the space. Where directors, etc., don't really know the negative impact it can have, especially going to, what we call them here. I'm not sure what you call them in the US is, sophisticated investors. We're just, someone who's certified to participate in equity raises. That can create a lot of overhang in the long term. And if you getting the wrong people and you're just diluting too heavily, then you can pretty much put the stock on hold for 12 to 18 months because it's just so much churn it's got to go through before they can actually, start realizing some value for shareholders.
Yeah, actually, you're right. We don't hate, there's reason to raise capital in the market. That's why these companies are public. And it's, definitely if they do it right with the right team and the right focus and the right goals, it can be a great thing. And I'm not, when it's sometimes, when they make sense sometimes, right? And sometimes it just don't make sense. If you see a company that's bloated share counts over years, you sort of see that this management team doesn't know what it's doing if it's not really growing, right? But it just keeps bloating up a share count. So I like to really pay a lot of focus and attention to that in my research phase, because none of this is a surprise. If you've got a CEO who's been at a company for say 3 years and all he's done is dilute shareholders, and what makes us think he's going to be any different in the future? So you can just see based on the history of the company in your analysis how they've treated their cash, and how they've managed equity raises, and you just expect more of that into the future. So if it's been handled well, then I don't go in being worried that they're going to have to raise capital because they've handled it well in the past. And there are actually times that you want a company to raise capital. I mean, if you own a company that's had maybe a 5 or 6, 7 year track record doing well and growing the company and executing and a good return on their investment, and you realize that raising equity might be a good thing because of the rate of returns they're getting on their money. So, and you might even want to participate in those equity raises at some point.
I was just about to say that because I know you do, and I do as well, that if I'm going into a company knowing that they're going to have to do an equity raise, say in the next 12 months, then I'd want to be a part of that and kind of lock up some of that capital for myself. And I
just actually today instant emailed a CEO and said, hey, if you're going to do a raise anytime soon, let me know, please, because I want to be part of it. And so we'll see. But that's the thing. If you have to ask, it's usually better if they're asking you.
Yeah, that's true. And I think sometimes when you've got some management teams that have a lot of skin in the game, like I've got one now, I won't mention names, but I've got one now where they are due to do a raise. It would really help their balance sheet, and instill some more confidence with investors. But they own 40% of the register. They don't want to dilute themselves. So it could actually go the other way, where they should be doing a raise and it's okay to do a raise, but they're not, and it's actually holding the company back.
Absolutely.
Yep.
So back to penny stocks. I don't want to dominate our conversation, but it's interesting to talk about them because we do think there's definitely value there if you do it right. I really don't care what any other investor thinks about us and our penchant for liking that sometimes. It's not everything I do, and it's not everything you do. But to have it as part of a bucket isn't that bad of a thing. You have a penny stock course, right? Or some kind of course you're doing?
Yeah. So this was about 12 months ago. I started thinking about, how do I kind of take my blog, my site kind of to the next level when it comes to education? Because I create a lot of articles around, my experiences, what I've learned, things that people should kind of keep in mind. And I thought if I can create a course that I personally did myself 10 years ago, and could have maybe saved 2 or 3 years in my kind of learning journey, then what would that look like? And I just over a number of months, I just started to just write down what are the key things that people should consider in this space. Like, this isn't going to mean you're going to go find the next 100 bagger. This is what should you be doing from a kind of a risk perspective to ensure that every stock that you're analyzing is taken through a specific set of criteria, and looking at stuff like cash on hand, equity raises, director shareholdings, and that sort of stuff, which can eliminate, 70 or 80% of your risk from the outset. And you just get rid of all those companies that, have very low cash levels, are run by people who have no skin in the game, and have never managed an equity raise properly. If you can avoid those situations, which will eventually lead to large drawdowns, then you kind of put yourself in a really good position to be able to make some good gains over time. Because I think the one thing, if you can avoid a large drawdown, it's fine to have little losses and only a few little gains. But over time, you'll find those one or two stocks that will kind of take your portfolio to the next level if you can avoid the large losses. So the main focus of this course is really just to give people that risk analysis lens to the penny stock world, so they can, avoid those stories that end up in the newspaper that make everybody, hate the penny stock world.
Yeah, it's really important. You mentioned too about reducing the universe. So whatever you can do to kind of make your research bucket manageable is really good, especially for a beginner investor or getting involved in this, or if you have limited time. If you're a part-time investor, and we have 20,000 MicroCap stocks here in the North America, and total stocks of 10,000 MicroCaps. And then, how do you get through that and bring it down to a manageable list? And it's really good to have a process where, you might miss some stuff, but at least if you can get down to something that increase your probability of having winners and making your time efficient, that's really good. And I think that's kind of what you're talking about there, is kind of creating a bucket of, hey, here's the high priority bucket to look at, and everything else, I'm going to avoid it, right?
Yeah, absolutely. That's right. Yeah. And it's all about risk reward, right? So, if we go back to that oil example, the reward of an oil driller hitting oil is huge, right? You could see 1,000% overnight, but the risk is if they don't, you're going to lose 95% overnight. So to me, that risk reward is unacceptable. So I think it's really important for someone to kind of define what they're comfortable from a risk reward perspective dealing with, and then from there find stocks that meet that criteria. So me, for example, I'm happy to risk 30% of my capital in a particular stock, to find in a stock that has the potential, to do 500 plus if management deliver over time. So that's my personal risk reward ratio. Minus 30 to plus 500. That doesn't mean stocks I'm buying are all going to do plus 500. That means I've got to have the potential in this space to do 5x over time. And I'm happy to lose 30% of my capital to try and find those scenarios. If it's more than 30, then more than likely I won't participate, even if the reward is through the roof.
Are you kind of putting are you letting the stocks, let's say you had that 30%, and a 500% type of criteria.
Yeah.
Are you you're going to be some volatility there? So if your stock falls 30%, are you still going to stay in it if the story's the same, or are you actually putting a limit there to sell it?
No, I honestly, in 11 years, I've never used a stop loss. I've never sold purely because of where the share price is. If the story is the same, like we use COVID as the example, right? Stocks that were performing tier one microcaps, or even story stocks that have really high potential with really minimal risk, they all got smashed in that kind of late February, early March period. And look where we are now. So I don't set up a stop loss or any kind of criteria to sell based on price. I sell based on the fundamentals. So is the story I bought in still in play? And if it is, I'm happy to hold. That might mean I'm wrong and I'm going to lose some money, which is fine. But if it's purely based on price, then I've seen I've gone through minus 50% drawdowns in a stock, which have gone on to be multi-baggers. So I'm really just worried about my story, my strategy, and then from there the price will kind of just do its thing over time. And if management deliver, then short-term fluctuations kind of even themselves out over time.
I totally agree with you on that. I've always thought stop losses were. I guess if you're a day trader, which I don't do much of, is maybe it means something, but the problem with stop losses, you can be, if you're wrong too many times, it can wipe out a lot of those losses, right? Gains over time. So just by
I get it for day traders, that's fine. But as in, if you're a microcap investor, you can't use a stop loss, and especially in liquid microcaps, you could have someone sell $500 and drop the share price by 10 or 15%. That shouldn't cause you to panic and sell.
Use it as opportunity, right? That's what we do.
Yeah. Yep.
Totally agree with you. Some of these spreads could be 10% just by themselves, or 20% on the bid and ask. So when you're looking at your, I guess, do you invest in U.S. stocks though, or only Aussie?
No, only Aussie for now.
Mm-hmm.
It is something I've been interested in. Like, why wouldn't there be amazing opportunities in the US, in Canada? I think Canada is very comparable to the ASX as well. Maybe it's just because we have such a huge microcap sector here on the ASX. I've never really felt the need to go offshore yet, but it will be something I'm interested in and potentially in the future. What about you? Do you do anything with ASX?
Not really. I'm with you. Same with you. There's so much opportunity, I feel, in the U.S. that I don't have to, necessarily try. I do some Canada now. I've found some. I used to really not like Canada at all for years. It was a stigma there. It still kind of is here and there, but of course, that stigma is what can cause you to want to go in there and,
there's the opportunity. Yeah.
Why am I kind of preach against that. So I'm trying to find a few jams, and I've been doing that now, and I've been enjoying it. So I'm expanding myself to Canada right now. I don't know where Aussie is going to fit in there, but I would like if I could find stocks with similar kind of capital structure requirements that I look at. I'd like to look at that area for sure. So, yeah, man. I also want to ask you about your $50,000 challenge. So you can talk about that a little bit.
Yeah, sure. So this goes back to the whole thing around majority of investors hating the microcap space. So I thought to kind of prove that microcap investors, penny stock investors, whatever you want to call it, can consistently make money. It's not just you'll get lucky with 1 in 100 and they'll just say you're lucky and you've got no skill anyway. That I thought I would launch a public portfolio where I kind of announce on the same day when I buy or sell a stock, and to see what kind of returns. And I'm looking for consistent returns. I'm not looking to find one stock that ends up being a 100 bagger, which obviously won't complain if that happens. But the reason behind it is to show some consistency that over time through different markets, microcap investors can consistently make money. And coincidentally, it was right before COVID hit. So I've stress tested my strategy through that period publicly, which was stressful at one time because I launched that obviously with $50,000. It's obviously real cash, and in the March lows, it hits just under 35,000, and then fast forward to now, it's just cracked 100K. So that volatility in different markets, and that goes back to the whole stop loss thing. Those same stocks that were down to 35,000 have gone up to over 100,000. So the purpose of the challenge is just to show some consistency, and hopefully I can just run it for a few years and show some decent returns in different kinds of markets and just kind of see what happens. And I was saying to Bobby in our first podcast that from a percentage perspective, the 50K challenge is doing better than my own personal portfolio. And I think that's because it's public facing, and you just think, I don't want to look stupid if I make a mistake. So you pay extra attention to everything, attention to detail, make sure you're not missing something obvious. And maybe that's something you're going to take back to my own personal portfolio and maybe just either make it public or just pretend that everyone's watching so I can
maybe you have your wife run the model portfolio with somebody.
No, I keep my wife out of this stuff, especially the profits. I can't show her the profits. She'll spend too much money. Do
you publicize the stocks that are in this model portfolio?
Yes, I'll keep it very high level because I want to avoid anyone thinking it's some kind of like a professional advice or anything like that. So I'll just kind of advise what the stock is, the day I buy it, what the stock is, my entry price, the reasons for buying it, and the risks I see with the company. And then when I sell it, provide a reason for why I sold it and just whether I realized a net profit or a net loss. And it's all the same day.
Are these trading, or are you holding these stocks? I guess that was the next question.
Oh, no. So 3 of them, which were in the portfolio when I first started, are still in there. And I think I've sold 2 and repurchased another 2. So I'm not trading. My normal kind of, I find my personal sweet spot with my strategy is about 24 months to hold that stock. So if they don't perform, I'll cut them earlier for sure. If they perform, if they kind of get ahead of themselves and the share price runs too quickly, then I'm not afraid to lock them in early if I feel that it's kind of just the priced in too much future potential, future kind of milestones being met. So I'll lock them in early. So I had one that I locked in, I think in 3 or 4 months, and that's very rare for me. Really, it's 18 to 24 months is when I normally sell. And a couple of those stocks are getting towards the 18-month period now, where they have been delivering, which is great. I'm happy to hold them. They're up, I think 2x, and one is approaching 3x. And I'm not at the stage where I'm happy to lock them in because the risk reward is still in my kind of where I like it. So happy to hold them until either management stop delivering or they kind of it runs too fast, too quick.
Great. Yeah, I thought putting together these like model portfolios are pretty cool. So I have my own portfolio also. Then within Geo, we've also created these model portfolios to kind of take we have a list of all of our long calls, which you might have seen, Gladiator.
Yeah, I see them. Yeah,
it's a lot of them though. So we in 2016, I think it was, or end of 15, we said, let's take all of our stocks that we're disclosing that we're buying and put them in different portfolios that are based on different themes, and that really helped me a lot actually. Even it basically helped me even with the stocks I own. It helped me say because we have a high conviction portfolio, we have a contrarian portfolio, we have a run to one portfolio, which are stocks under one that we think are going to go over one eventually. So it really helped me put things in perspective. And I think it's actually made me a better investor by doing that, by forcing me to find out of maybe 40, 50 stocks I may own at some point, the best 10, because it made me think about it. And I really like doing that. So maybe that's what you're kind of going through here too. You have your live portfolio, exactly. Then you have your model portfolio, which you're really maybe paying a little more attention to because you're public facing and everything. And I kind of see where you're going on that, and you don't want to let your people down, right? And,
yeah, exactly. I don't want to let the microcap community down. Let these large cap investors, laugh down at us. So I got to keep it strong. And I want to get your view on, what I was just going through around if a stock runs too quickly, even though it's still a great stock, what do you do in that scenario?
Yeah, that's the subject of what I'll be talking about in a video on Geo and maybe this hopefully later this week. Buy, sell, or hold. Like, how do you know what to do when a stock goes up? And that's really, it's not an easy thing, right? I mean, there's from the perspective of, okay, there's two perspectives. Do you already own the stock? So you're coming into it from that kind of position, then it's gone up, right? Or are you new to stock and it's gone up? Are you afraid to buy it? So what do you do? And those are really the decision we struggle with. And a lot of it depends on the environment, man. So, that's so the first step really is to figure out when you're looking at a stock, are you looking, where is that conviction level first of all? And is it going to be you anticipate it being a short-term or long-term play for you? So, are you buying a stock that's just a COVID play that, has a mask play or a sanitizer play, or are you buying more of maybe a longer term kind of trend? And these are things that you need to start, thinking about. That's how I do it, at least. And then you have your long-term and your short-term stuff. And the difficulty, let's start with the short-term's easy. So you buy a stock, and when I was doing short-term, and I do that, I try and find a stock where I think is a catalyst for the next 4 or 5 quarters that's going to really pay off for me. And that strategy worked really, really well in my first 20 years of investing before 2008 came along, first couple decades. And the situation there was that these tier one microcaps were very in demand. It worked really well. And the market was, would find these stocks and bid into a value that I thought was appropriate relatively quickly. So that was probably a 6 to 12 month investor and my longest really. Just trying to find these really powerful inflection points, and it worked well. I never really thought long-term per se. And then 2008 came along, and that strategy wasn't working anymore. Really after 2008, these tier one companies were not in play. We lost a lot of investors, retail investors that invested in these companies. Institutional investors couldn't invest in these stocks anymore, didn't want to. The regulatory environment got a little tougher. A lot of brokerage firms make it harder to buy these stocks. So the amount of money being thrown into these companies wasn't as aggressive as it used to be. So my strategy wasn't working well anymore, consistently enough. So I had to change my view to, why I need a longer term type of perspective on what I'm doing here. So then that's when I really started becoming more a long-term investor. So, looking for those kind of companies. So the challenge with but I think now we're back though. By the way, I think now we're back to that first couple, 2 decades of, at least for now, of being able to find these inflection points and having them run to a short-term price target. So that the challenge then, okay, so these companies that I might be buying short-term, do I want to invest in any of them longer term? And how do you set a price target 10 years from now? It's really tough, or 5 years from now. So that becomes a much different analysis of deeper analysis in the company, deeper in the management team. So now I'm thinking, okay, well, if a stock has reached my short-term target, based on some valuation, I'm still going to keep it, or I might sell some of it, of course, to emotionally help myself feel better that I took some profit at the table. But if I ask myself this one question, can this thing be a lot bigger 5-10 years from now? So and if the answer is yes, I'm not going to be too concerned that's overvalued right now, because I might have to suffer for 6 months, a year, the stock going down a little bit and maybe not moving, in anticipation of the next big maybe a five bagger or 10 bagger. And it forces you to look at a company longer term and trust in management that they're just going to continue to deliver for you. So, really determine if you're holding a stock short term or long term. Hit your short term target, get out. Don't make excuses for, holding it longer term. The only excuse for holding a stock past your short term target, in my opinion, really, is if you've turned that company into a higher conviction play, where you don't really care about price targets, when you care about the company growing over time, and then it's going to grow into it. And that's what I've kind of been trying to do better. So my core portfolio is really probably mainly comprised of these really high conviction stock plays where I don't really care about valuation now. I just think they're going to be a lot bigger in the future and go up a lot. And I'll try and figure out when that story changes, if it does. And then I would say that's about 70% of my portfolio, maybe. And then around that, I have these shorter term kind of inflection point plays that we talked about earlier. Now with the market getting a little better for these microcap stocks, Robinhood, you got who's that guy? Dave Portnoy, whatever, is that his name? So the guy,
yeah.
Or what's his name? I forgot, but he's a character or whatever. He's bringing money into the space, I guess. And so you have a lot of millennials getting involved in these stocks. So I see a lot of permanent volume coming into the space. So in that respect, there is opportunity to make money short term in this tier 1 space. So I am finding myself taking some bigger bets around that core strategy now, and it's working right now. So
I think you raised two key points that I picked up on. So the first one was, you've got to be like, when you've been in this space long enough, when a stock is kind of overextended and that it's going to come down. And if you are a long-term holder in the stock, it's really hard to be able to just kind of accept that the next 6 or 12 months aren't going to be great from a share price perspective, and be willing to kind of go through that with the long-term kind of view in mind. And the second thing was, you can only do that if it's a really high conviction play. And if I'm just running through my portfolio in my head, I've seen a lot of stocks where I've cut them because they've run too fast, too quick. And I've got a couple now that did run really fast, really quick, but that was still much lower than I thought they could be in a few years' time, in that 24-month period of time. So I left them knowing that the share price was going to go down, and then hopefully in time recover and then go on to new highs. So it's a difficult balance. But yeah, without conviction, there's no way you could hold them.
And what's funny, and it feels better too. You don't have to worry about it all the time, right? But I know, like, one of my best stocks I've owned, I had it for for a long time, I think maybe 13 years. When I first bought it, it was okay. Well, I bought it maybe 10 cents, and then I had a price target of 50 cents. Then I had a price target of $1.20. Now it's.
Well, if they keep delivering, then
yeah.
Why not?
And it was always really never tremendously undervalued, but they just kept growing the company, and eventually revenues, were just started accelerating. And the stock, I think, hit 13 recently, and that's an example of it. So the stock still is aggressively valued, but management keeps delivering. So some of these stocks that have management teams that keep delivering year after year, you need to start having confidence in them. If they really have these really incredible business models that have good competitive advantages and some moats maybe. And I've learned that. That was something I learned that very late in my investing career to do that because I was forced to. And I really started I really enjoy it. I think I wasn't really a investor for many of my early part of my career investing. I became a much better investor when I was forced to abandon that short-term stuff and start looking long-term. I'm glad it happened, actually. Really glad it happened. I enjoy life more, actually, too, with that kind of strategy. Not having to worry about every freaking tick. Knowing that I have more confidence in the teams I'm investing in, it's just a lot better feeling. And to go through it, you got to go through it. So going through COVID was really interesting for me because I went through a correction, and I didn't panic at all. I've panicked in other corrections here and there, regrettably, because I didn't know my companies as well as I would have liked to, and I owned actually too many of them. But so this whole COVID thing was really a test of that whole new strategy, and I'm really enjoying it. I mean, I enjoy crashes now. I enjoy pullbacks. So
that's a weird thing to like.
Yeah.
Well, if I just think, yeah, well, I was actually tweeting about it yesterday that, it's hard enough finding one really good stock than, having to jump from stock to stock, trying to find the next kind of multi-bagger. The odds are just so low. And sometimes the hardest thing is to just actually do nothing and just leave them as they are and give them kind of the enough room to grow over time.
Absolutely, man. I mean, it's like when you're short term, you're recycling everything, right? And then what happens a lot, and what could happen in that situation, is because you're investing in like short term type of things, and you end up in this rinse repeat cycle. You could make a lot of money. I was making a lot of money, and then you end up being fully invested potentially in a market crash where you just have shit companies long term. So they can't cycle. They don't come back sometimes when they fall because whatever was going on with them short term was a very short term thing that was dependent upon what's going on in the market and maybe in the business environment that maybe changed permanently after the crash, whatever. So I just feel like sometimes less decisions is better, right? Not have to make as many decisions is probably a better situation instead of having to.
I've definitely been caught in that position, cycling through stocks and making a lot of money, and then market turns and you pick it up too late, and then you're pretty much stuck. And you either have to cut them for big losses or you hold them and you're just holding with hope, which never kind of ends well. So, it's a strategy that can work in really good times like the market we're in now. But when things turn, it can turn against you very quickly.
I remember doing, my taxes when I used to do myself, and I was forced to do all the, write everything in, physical entries and everything on the schedules. And I'm feeling, I made all this money this year. And then I would go look at my picks. Oh my God, most of them sucked. I made most of my money, and maybe my top, 15%. And it was like, and I just, oh wow, that's interesting. And then I got that postmortem. So that was a good eye opener too.
Yeah, and going back to what you were saying about enjoying crashes, if I think back over the last 10 years in my early, and these weren't kind of, a lot of this just happened on the ASX, so you guys wouldn't have known about them, but there were quite a few kind of mini crashes in the microcap space. And even when kind of Trump came in as president, we had a huge drop here. So in the beginning, it was all like, it was freak out, place all these sell orders in great companies that didn't deserve to be sold. And then come COVID time, it was actually the first time where I was really calm about the whole thing, which I think that gave me a lot of confidence in my own kind of maturity in the space and how much I've grown that, if this happened a few years earlier, I would have just completely freaked out, sold everything and bought back in at the wrong time and then even lost more money. So I think, sitting back and just doing nothing and just letting things play out is most of the time, I think, is the best thing to do.
The thing is, sometimes boring isn't fun, but
yeah,
if it makes money, I'm okay with it. So,
but that's the aim, right?
Yeah, I used to feel guilty. Actually, when I first started doing my research when investing, I would because I had other jobs, so I couldn't do it every day, and I used to do my research like every Sunday for 5-6 hours, a skull session, and did really, really well for many, doing that. And then I figure if I was really obsessed with doing research every day, getting obsessed with it, I do a little worse sometimes. So it's kind of, I feel guilty sometimes for not doing it every day, but you don't need to be, in front of your computer every day if you're doing it, what we're talking about. And that's something that's really enjoyable too, when you're investing for the long term and investing in the companies.
Yeah, absolutely. I think that's what kind of sets. I don't know how I have a lot of respect for day traders. I don't know how they do it, but being in front of the screen all day, watching tick by tick what's happening, it's hard to do. And you're right. You want to get to the point. Of course, the early years you've got to put in those hours, but you want to get to the point where you can have your core portfolio. That's you got great stocks. You got a wish list of stocks on the side. You just keep an eye on them to see what they're doing, and just kind of enjoying life.
Yeah, and I'm not knocking day trading. I mean, I know people who would do well at it. It just wasn't for me. And I think, you can either be this, hey, 70-80% of your portfolio in just long-term core strategy with a little bit of short-term trading, whatever the day trading in there too. Maybe you're a day trader of 80% of your portfolio. Maybe you do a little around that, put, some core positions on for the long term. I think they can work together. There's no one solution, right, for investing. So that's what's nice about it.
Yeah, I think there's one thing that people underestimate is just really understanding your own personality and bringing that into your investing. So someone who's really, high energy, always out doing stuff, that might be great as day traders, right? Because they're used to that and they kind of thrive on that action. But if you're not that kind of person and you're trying to be a day trader because you've seen other people do it, then you're just going to fail. And the same on the other way. If you are a really high energy person, then you can't be running a Warren Buffett type portfolio, holding stocks for 40 years. You just kill yourself. So you've got to find your balance with the personality, with your investing style, and when those two things come together, you can find a really good balance.
Yeah, I remember in that 2008 crash, I was like, oh my God, I was down 65% of my portfolio. It was funny. I was up 20% going into September, feeling like I was a hot shot, and lost it all like in 2 weeks. September 2008, what am I gonna do now? I was like, how am I gonna live? Because I was, really supporting myself in my portfolio.
Yeah.
And I started day trading, and man, I just, it was exciting that I can see the adrenaline you get from it. I mean, doing because when you make a good trade, you love it, and you can get streaky in it. But then when you get like you lose your first 3 or 4 in a row, I started losing confidence, and I was like, I just was not enjoying it at all. I mean, I didn't know where the day went. Yeah. It felt like 10 hours went by in 30 minutes. So exhausted. And I had a trader, I'm yelling, I gotta do this. That was crazy. And big beard and big afro. And then what was funny was I still, though, around that, had bought like 3 or 4 stocks and held them. And that's what got me out. I mean, I made some good day trading here and there, a few lucky hits, but it was those 4 or 5 stocks that I had a little bit of, that I had left my money that got me out of it. And it was pretty, pretty funny that's how it worked out. But yeah, I do it once in a while, and I go back and let me try day trading stuff again. And I still, if I do day trade, I like to combine it with fundamental investing, where I know like a catalyst is happening. Maybe it's a lower quality company, not quite a tier 1 company, but there is a catalyst happening. I'll try and hit one out of this park once in a while if I can. But it's not really what I enjoy anymore, or really much I really ever did.
Yeah, it'll be tough work, but yeah, I agree. If you feel every now and again you need a bit of an adrenaline rush, why not have a few day trades and see how you go? But yeah,
remind myself how I am at it. So.
Yeah. An annual reminder. Even when you've got some of my own stocks that at some stage of their development they hit a huge milestone, and the company runs overnight. I feel exhausted by the end of the day. I'm not even trading. I'm just watching what's happening, and by the time the market closes, I feel like I've run a marathon. I really haven't done anything. So you just got to find what works for you and find that balance.
And I want to ask you one last. I mean, it's been a long time. I think Bobby's going to pass out over there really quick. So I want to maybe ask you one question here. So we do a lot of we call it information arbitrage here in geo investing, which is digging into filings in the MicroCap space, or digging into conference call transcripts to see if we can find information that's just sitting there that really hasn't been talked about in the press releases or anywhere like that. And that works really well for us. We had when we talked about the weekly letter this week, if you read a Gladiator. But so I'm wondering, is that something you do, or are those opportunities? Explain the process. There's SEC filings here in the U.S. What are the filings or the mechanism that you use for research? I'm sure you got press releases, but does that same information arbitrage kind of exist in your markets also?
Yeah, so we have what we call quarterly announcements. So it's a quarterly activities report, which gives like a fundamental view of what the company's been doing over the quarter and what they're looking to do in the next quarter. And we have a quarterly cash flow report, which shows it's not at like an annual report level. There's no balance sheet, profit and loss, etc. But it's a high level view of the finances for the company over the quarter. And then obviously we have half yearly reports, which is for the first half of the year, and then an annual report for the entire the entire year. My personal strategy is very similar to yours, where I don't look out for kind of press releases or media releases or analyst reports or anything like that. And I know Ian Castle talks about this as well. A strategy that he uses, it's kind of just the A to Z approach, where I'm just going to pull up a list of stocks under a particular market cap and just work through them one at a time. Really boring, no scanner, and just trying to find stuff in there that nobody else has kind of put the time in to find. And I think that's where kind of my edge comes in, where a lot of people are finding their stocks on scanners, which everybody has. Not many people are willing to go through, dozens or hundreds of stocks and do some in-depth analysis on them, just based on, it could just even be a paragraph in a quarterly report, which piques my interest, and then just do some research around what that means for the company. What could it mean in the future? So yeah, I definitely, I stay away from ways of finding stocks where the majority of people can stumble upon them as well. And that includes social media. And I really just like to do my boring A to Z stock analysis. And it takes a lot of time, and you've got to go through a lot of, let's say for every 100 stocks, maybe 10 of them deserve further research. And of the 10, maybe 3 kind of make the cut. And out of those 3, one of them's probably, run too far, and it kind of doesn't make sense from a risk reward perspective. And you're spending kind of weeks and months worth of work to find 1 or 2 stocks. But it's that kind of scenario where if you're willing to go through that that process and that pain, then you can find a stock that no one else has found, and you can kind of get set slowly over time if it's in a liquid micro cap, and then just watch when the milestones actually start coming through, everyone else piling in much higher multiples than you did. So that's kind of what works for me, and that's what I've been doing.
Excellent. Yeah, the one we actually came across, which I won't give out the symbol right now, it's too illiquid. But it is under $1. And if you recall, like these guys, they won a contract with the government, and they won the contract from an incumbent who had been servicing the contract, I think, for several years. And this particular company that we actually own it was basically depending on this contract to get the profitability and really get revenues going. It's a clean capital structure, zero debt. They've had a hard time getting, momentum. And this particular contract was supposed to be it. And they were awarded a contract, I believe, at the end of last year. And the incumbent, I guess there's a process where you can protest it. And they protested it. So then there was, I guess, another arbitration kind of phase to the whole protest. And then we saw the stock. They had earnings last week. We're pretty a good revenue number. I think they broke even. And then when you read, and this company does not put out press releases. It hasn't put out press releases in a long time, so you got to read the filings. And they talk about this in their filing, and they talk about an update on this. And actually, the incumbent withdrew their complaint, which means these guys get the contract. And basically, I think they said for the next 7-8 years, they're expecting a significant amount of revenue, predictable revenue from this contract, which we're running the model right now to see if that means consider profitability, but we think it does. So that's only in now. If you look at the price, the stock price chart, it was slowly inching up over the last 3-4 months. Because actually, I think if we would have looked 3 months ago, we would have found this information in the Q1 filing, as opposed to Q2 filing. And the more you can see this, eventually everyone's going to find this, right? They'll probably put out a press release at some point, and the whole market will find it. So that's a classic case of how we use information arbitrage. But I promise, last question. I'm sorry, Bobby. So we are big on using Form 4 analysis here, which is looking what insiders are buying and selling, mainly what they're buying. When they're buying. So we like to look at insiders that are buying shares directly in the market. And we're looking for those transactions, not necessarily the warrants and options. Is there a similar type of filing you guys looking at that you look at for insider buying? Does that filing exist in your market?
Yeah, we do. We've got I think it's called Appendix Z. I forgot the exact name, but yeah, every time a director or insider purchases any stock, they must announce on market. And it's got its own particular announcement form that they've got to populate and kind of announce to the market. I'm not sure the exact time frame. I think it's within a couple of weeks or something. And same with substantial holders. So anyone who purchases over 5% of the capital of a stock must announce. And then whenever they buy or sell, after they've announced their 5% majority holding, they need to announce that to the market as well.
So do you ever use that? Do you use that in your
really important for me. Definitely. It's one of the most important things, not just how many shares directors have, but how did they actually acquire them? Were they performance shares that were kind of really easy to achieve and kind of gifts, or were they stock that was purchased on market at the same price as everybody else and just showing kind of confidence in themselves and the company itself? And same with substantial holders, because when you look at a capital structure, let's say you've got 100 million shares on issue in a typical microcap, then if you've got 3 or 4 people holding, let's say 30 to 40% of the company, and hopefully management's in there, then you've just tied up, the vast majority of shares on issue. And so there'll be little supply there, or loose shares, I call them, where they just keep flowing into the market and just keep depressing the share price. So I definitely I look at the capital structure we call them the top 20. So in every annual report, we get a top 20 report for each company, which shows how many shares the top 20 shareholders hold. And obviously it would look at management holdings and exactly how they acquired the shares, which we can find in the annual report.
Excellent. Well, I think that's good. Glad it was a great conversation. But one thing I learned here, I should probably be investing in your mock portfolio.
Don't do it.
If we went into that, because I have no ego over here. I'm gonna definitely. I love your process, man. It's very similar to mine, and you do it in just a different country. It was awesome learning about your process. Tell us where we can find you and where investors can learn and follow you and learn more about what you do.
Yeah, so my Twitter handle is at the Gladiator HC, and my blog / website is www.specinvestor.com.au. Great.
And for me, my company is geoinvesting.com. You can go there, and we have a 7-day free trial if you're interested in our memberships. We also have a 30-day membership also, which was relatively new. You can follow me personally on Twitter at Maj GeoInvesting. You can follow GeoInvesting directly at geoinvesting.com. You can email me, maj@geoinvesting.com, or call me at 267-246-3263. As always, I love talking shop, and it never bores me, so call me anytime.
Yeah, no, I'm a premium. Sorry, just to finish off, I'm a premium subscriber to Maj's Geo Investing, and if you want to know how much work you should be putting in as a microcap investor, and how much analysis you should be doing, just sign up, and you'll see the amount of analysis that gets sent out in your weekly emails is pretty much the benchmark of what every microcap investor should be doing. So it's a great service.
Hey, thanks.
I'll co-sign that.
Yeah, Bob, you're getting them too, right?
Yeah, no, look, you guys, this might be the best interviews of you both that I've ever seen. And that includes, I just interviewed both of you. So, I loved it. I
heard Maj loves getting lattes in the cafe. So this is just kind of just like a cafe over coffee conversation.
All jacked up right now, so.
Poor guy. It's 8:00 where he is right now. I don't know if he's going to sleep now. He's going to be looking at Aussie stocks all night.
I love to do. I love to do. Hey, Gladys, do you ever want to consider doing like a stock pitch one time? Maybe in the future, like taking us through a presentation, maybe of what stock you like and why you liked it.
Yeah, absolutely. Let's do it.
Great. Yeah, that'd be awesome, man.
All right, let's let the people go. Thank you guys. That was awesome. You can also follow the podcast at avoidingthecrowd.podbean.com. You can subscribe to the podcast on Apple and very shortly on Spotify as well. And keep following along for updates. My Twitter account you can follow is at Bobby K Craft, BOBBYKKRAFT. It's where I tweet out every new episode of the podcast. You can also find each episode on our YouTube channel, youtube.com/SNN Wire. That's SNN.Network YouTube channel. All right. Thank you guys. Get some sleep.
Thanks, guys.
Well, actually, Gladiator, enjoy the rest of your day.
I'm just starting, yeah.
Thanks, guys.
All right, guys. Cheers.
This podcast is for informational purposes only and is not an offer or solicitation of any offer to buy or sell securities. SNN.Network and Maj Soueidan are not licensed brokers, broker-dealers, market makers, investment bankers, investment advisors, analysts, or underwriters. We do not recommend any companies discussed. We may buy and sell securities in any company mentioned and may profit in the event those securities rise in value. We recommend you consult with a professional investment advisor, broker, or legal counsel before purchasing or selling any securities referenced in this podcast.